what was your first sales job?
I mean, I guess you could say, I mean, I started a company when I was 14 mowing lawns. It was called Reasonable Rates Lawn Care. And we had to walk around like door to door and convince them to use us instead of like, whoever else they were using. And
Neighborhood kid like me that was only mowing one lawn because my dad made me make some money.
it was a neighborhood. It was certainly a neighborhood thing, and it didn't last more than a summer. I think it was. I think it was 2 summers. I think the second summer we might have hired people to do it. I was so small I could barely push. Like I think when we got like a propelled mower, so that you wouldn't have to like it wasn't as heavy. Maybe I'd get back into it, but it was. I was probably more on the sales side than on the delivery side, but I was definitely doing a lot of sales, and then eatblue.com, it was sales restaurant, door to door for 4 years. As the founder of the company, I was also head of sales, co-founder. And I think I became head of sales only because the day that we had to go start selling into restaurants, I think the other two guys were busy. And I was just like, okay, I'll go do it. And so, it wasn't like some big deliberate like interview process. We're just like, okay, guys, I'll do it. And then I started doing it and liking it. And so they're like, okay, he's getting good at it. Let's let him keep doing that. But every job I've had has some, in my opinion, some sales component to it. If I'm trying to invest in a company, I spent 10 years managing Dan Gilbert's venture investments, investing in tech companies here in Detroit. And if I'm trying to invest in a company, I'm trying to sell that founder, hey, you should take our money instead of somebody else's. So there's still sales there. And so like I said, every job has a sales element to it.
Well, let's pivot to that for a second, because I think you just hit upon something that most people who are seeking to raise capital don't understand. And I've only started to understand this recently, just because of where we're at in our cycle. But you just said that you'd have to convince somebody to take your money,
right?
And that's a great spot for somebody with a business to be in, right? But maybe expand upon that a little bit. Why would you have to convince somebody to take your money when somebody you hear people they're first off, we see everything on CNBC where people are raising next round hundreds of millions of dollars, and everybody thinks, man, everybody just is throwing money at them. Why would a company not just take everything they can get? So expand upon that a little bit. If you
don't please, I'm happy to. I mean, first of all, I'll just say one thing, which is there's something called selection bias. I like thinking about like cognitive biases and things like that, but there's a bias called selection bias, which means like we look at only a certain selection of data points when we make our decision, and depending on how we select that information, it might give us the wrong conclusion. And I would say great example of selection bias is when you're looking at headlines and assuming that that's what fundraising is like, because really you're just looking at the most successful, most outrageously successful fundraising experiences. But 99% of fundraising isn't what you see in the headlines. It's everybody that doesn't make the headlines, right? And so it'd be like trying to figure out like what it's like to play basketball and only looking at the most successful pro players. But most people playing basketball in America never make it to that level. And so so certainly it looks easy to raise money. It's not, and it's difficult. And you talk to investors and they look at 100 companies will invest in one sort of thing. But there are the scenarios, where a company is onto something, and once it's obvious that company has growth and has, something special, it's obvious not just to one investor. It tends to be obvious to a lot of investors all at the same time. Some visionary investor who can see it before everybody else, that's an advantage for them, right? Because they can now go and invest in that company before it gets competitive. But most people aren't visionaries. It's not, most people look at the data and look at the evidence and they say, okay, this company's probably going to be a great company and I want to invest in it. Well, everybody comes to that conclusion at the same time. And now you've got 100 investors trying to invest in the same company. And that's when I'm talking about having to sell to the founder as to why you should take my money over taking all that other money. And to your point about, well, could they take all the money? Well, they just don't want to sell that much of the company. They might want to sell 20% of the company. They probably don't want to sell 90% of the company. If they take everyone's money, they're selling too much. And so, so they might say, okay, I want to raise $3 or $4 million. And sure, you can compete on price. I say, I'll pay a higher valuation, but at a certain point, you're going to max that out. and you're just gonna have to choose between several investors, which of them I'd prefer to have as investors. And I'm going to take the $3 million from someone. Again, this is that like small slice of the world where you find where a company is in a position where they get to choose. I've been on both sides of that. I've been at I've seen companies where, they're looking for money wherever they can get it. And then fast forward, that same company 2 or 3 years later is now turning down investors. And it's just the catch-22 of building a company, right? You need money to make progress. You need progress to raise money. That's the catch-22. As soon as you have the progress, you got all the money in the world because people are interested in investing in you. But, boy, it would have been nice to have that sort of interest when you were just getting started. And it's, if it was that easy, then everybody would be a successful entrepreneur. So anyways, I hope that's a roundabout way of kind of answering your question.
No, that I think that's great. But what do you, so you've been in the VC space. What's the difference between VC and private equity?
VC and private equity.
Why would you be cooler to the private equity guy?
As it turns, VC and private equity, people probably have all different explanations, and I'm sure they start to blend into each other at certain kinds of things. But I think of private equity investors as people that invest in profitable companies that are later stage and are looking at like multiples of EBITDA, as they're valuing businesses. And I think of venture capital investors who are looking more at markets and market size and team and product market fit and trying to predict, if a company can be a really high growth, fast growth business, as opposed to just analyzing what is probably a mature business that's already profitable, but how many more multiples can we drive that thing? I usually think venture capital comes first and private equity comes later or last. That's how and I'm in venture capital. And I've been affiliated with some private equity folks, and we used to joke that, if the company's not making any money, send that one to me. And if they're making a lot of money, that one goes to the private equity investors. So private equity investors have more data to deal with when they're making their decisions because they're more mature businesses that they're investing in.
So is Signal the first one that you've taken on kind of as a adult? I mean, I don't like calling ourselves adults because I feel that way. Regardless of our birth date.
Yeah, we're adults now. When I was a kid in college, I started Eat Blue and UGrub, and that was awesome. It was a lot of fun. But I came out of that experience saying I could have known a lot more headed into this thing. And man, like next time I do this, I'm going to just be so much smarter, and I'm going to have so much more resources behind me. And I'm going to come back to this thing, and I'm going to build a company. And that actually got me into venture capital as like a career path. I was like, this is going to be a great way to learn about entrepreneurship. It took me a lot longer to come back into being a co-founder than maybe I predicted. When you're 20 years old, 22, 24, 5 years is probably the longest you can even think. So the fact that it took me 10 years to get back here, but now I get to be a co-founder and build a company again and use all the things I learned in venture capital and all the things I learned in, back at UGrub and Eat Blue. So it's a pretty cool opportunity for me to bring all that to bear. And by the way, it's still not easy. Even after, investing in all these companies, being in all these boards, and Pat Kelly, my co-founder, and Kevin O'Hare is my other co-founder. We got 3 of us. We've all built companies in the past. So we're all kind of like, but we all still have a chip on our shoulder that like, we want to build something bigger and better than what we did in the past. And so, being able to bring all that experience to bear, man, I just remember how little I knew when I got started. That's what it reminds me of. When I got started in my first company, I'm like, amazing that we were able to make it as successful as we did, given how little when you first get started. But it's a lot of fun, regardless of the stage you're at.